What's going on, traders? Andrew O'Connell here with Pristine Capital. Welcome to your market recap video. It is October 5th of 2022. Let's dive into these box scores. S&P 500 finished down 0.23%. Our NASDAQ QQQ finished down just 0.05%. Our IWM small caps were down 0.74%. Dogs of the Dow were down just 0.12%. And our ARK Innovation ETF was our biggest loser on the session, down 1.84%. You can see pretty much all of these indices, they did close towards the upper end of their day's range. And ironic, ARK had the worst daily performance, but it closed at the highest end of its day's range. Interesting. Volatility, despite the market going down, volatility contracted. This is definitely a positive divergence that we are seeing. And then in terms of breadth, you can see small caps only had 29% advancers. We had overall up volume of 36.6%, and the trend model remains at a +1. In terms of today's economic data, we did get some employment data at 8:15 a.m. We had the ADP employment change figures for September. And these, they're just kind of like the joke of Wall Street. These numbers come out every single month. The number that everyone really trades off of is the non-farm payrolls data. That's going to be out on Friday. That is widely watched by Wall Street. ADP is like another employment gauge, but to be honest, it doesn't track the NFP data at all. So it's a huge joke. Like sometimes the NFP data will be like horrible, but the ADP was really good and vice versa. So it's just kind of like a wild card of a number. But that said, the market's been so volatile, so thin, that the market's pretty much moving off of everything. We did have a pullback today, and this came out better than expected. That's definitely not what the market wants to see, right? The market either wants to see signs the economy's slowing, or even better yet, that inflation is slowing. And you can see we also had the S&P Global Services PMI came in at a 49.3 reading. That is a contraction, but it came in 0.1 better than the estimate, which was 49.2. Remember, we remain in this environment where good news is bad news and vice versa. The ISM non-manufacturing PMI, it did come out well above a 50. This is for the United States. And this, came in at 56.7. Estimate was 56. Again, better than expected data, not really the best for the market. This is what we have on tap for tomorrow. We do have initial jobless claims. And I believe the same thing is going to apply. Wall Street wants to see the poor's losing their jobs. They want to see a number that's above the consensus. I would imagine we're going to see some pre-market movement tomorrow based off of the claims data. VIX Futures term structure did uninvert in these front 2 months. That is definitely a good sign, and it's showing us that perhaps we are past the eye of the storm. Finviz Heat Map, you can see it's pretty much like a mixed tape. We had big weakness in utilities. We had strength in energy, which is not what we want to see. Tesla just remains so weak. This stock is just getting bludgeoned. And this market environment, it has punished every style of investing, every sector, every country, everything has gotten hit. The last couple of stocks that were not really hit were Apple, which ended up taking its beating. And now Tesla is taking its beating as well. So it's very tough to find areas of the market that have not been hit by the sell-off. Now this is pretty important. I posted this on Twitter yesterday. This is CTA positioning estimates via Nomura. Nomura, they have a chief strategist. His name is Charlie McElligott. He's brilliant. He's like one of the only strategists that I think has real edge on Wall Street, because all their data is based on market generated information, dealer gamma levels, CTA positioning, triggers, that sort of stuff. And what they've identified, this was as of October 4th, so it is 1 day old. Maybe this changed slightly, who knows. But they identified these CTAs, they are net short the market, but they are going to have to buy stocks on the S&P 500 if we get above 38.19. And right now we're trading pretty darn close to that level. So I think it is important. I know everyone's saying like, who would buy this market? But there's a lot of mechanical buying and selling that occurs in the market. And this is just one example of how we could end up squeezing a bit higher. Sectors. We had energy, which is now in our top momentum slot, up 2.07%. I will note We did get some news after hours. The Biden administration is preparing to scale down sanctions on Venezuela's authoritarian regime to allow Chevron to resume pumping oil there, paving the way for a potential reopening of U.S. and European markets. Let's see how that impacts energy tomorrow. So that is definitely something to keep on your radar as well. What else performed well? The semiconductors, relative strength up 0.82%. Interesting. We had the Chinese internet stocks. They were also up 0.11%. And software was up 0.4%. So even though we had a market pullback, there were some glimmers of hope in there. Some things that were acting a little bit better and diverging from the overall trend. In terms of style factors, what performed best? The momentum style factor was up 0.13%, and the quality style factor was up 0.02%. I will note, high beta was not really an underperformer. It was only down 0.21%. The big underperformers, we had high div low vol, which was down 1.19%. We had some of these international groups down, and then small cap value was down 0.95%. In terms of trades for today, these were the stock trades that I did. I closed out MNTK. This was, to be perfectly honest, this was an absolutely dreadful trade that I did when the market was in a -3 environment. So this is one that I just should not have taken in the first place. And this one, again, like I spoke to this yesterday. I was allocating to stocks that were showing relative strength, but in a -3, very weak market. That's a big mistake that I made in mid to late September, because effectively, now with 2020 hindsight, it's something I'm going to take with me, forever. If you allocate to relative strength when you're still in the eye of the storm, you could really just be allocating to the next group to get hit. So this one, I gotta say, I was very disappointed in myself on this one. I could have taken my stop way earlier. This is very frustrating for me. I take this very seriously. And it's just a mistake. It's one that could have easily been avoided. But it's really just a learning lesson. I want to make sure that I'm tighter with my stops. I made a couple tactical errors in September, and the market really just exposed me on each and every error that I made. And this is one of them. And then when I sold this thing, I'm pretty sure I practically bottom ticked it. I sold it right at the end of lunch, 12:55. This thing ended up rallying higher. So this was just I'm glad to have that one in the rear view, to be honest. I just want to move on from that. And then I also took a position in the TQQQ. This is the NASDAQ Triple Leverage ETF for 22.29. I just wanted to add some market exposure. And I must say, this market environment, the fact that we're in a bear market, it has not really been a stock picking market. It's, as far as I'm concerned, because the overall market's gone down, it's not oh yeah, there's been so much alpha, picking the right names, whatever. It's really been all about just where are you taking market beta exposure. And, the people that have been lightest on exposure have done the best because the market's been negative. If you've caught some of these bear market rallies, you've done very well also. And so, yeah, I was like, you know what? I'm looking at these stocks. I don't know if I'm about to pick, the next one to just get clobbered or what. So let me just keep it simple and buy the TQQQ if I want to add that exposure. S&P 500. We did pull back to the 5-day EMA, and we talk about this all the time. But the further extended away from the 5-day EMA you get, the more short-term market risk that you have. And so today, perhaps it was an emotional day, oh my gosh, market's down after being up 5% in a straight line. Honestly, you got to just be able to put that aside and just look at the bigger picture, or, just keep in mind your thesis, your stops, whatever it might be, because we ended up closing out with a pretty benign candle here. The market never moves in a straight line. And this is actually a good thing because this 5-period exponential moving average is going to catch up to price. So even let's say tomorrow there's not really much movement, or let's say tomorrow again we pull back to that 5-period exponential moving average. I think, that's pretty highly likely because we just test this level all the time. It's I'm sure there's going to be investors that are freaking out if it happens again. We trade to 37.60 and be oh my God, it is the Lehman moment. But it is important to note, look how darn close we are to the 20-day simple moving average. I guarantee there's a ton of stop orders, people that are short that are going to stop out above the 20-day simple moving average. Then on top of that, we have that CTA trigger level at 38.19, which just so happens to coincide with this 20-day. So think about it. If you're like a smart money investor on Wall Street, let's say you have big capital. If you know that there's buyers that have to automatically step in at 38.19, if you buy below that level, there's always that question, well, if you buy, later on you need to sell, right? And you're hoping that someone else will buy the shares that you're selling. So if you're in an uncertain environment, it's like, well, I don't know if anyone will be there to buy my shares. But in this case, you literally know that there's mechanical buyers if the market just pushes up incrementally to a slightly higher level. So to me, this is kind of a no-brainer. It does seem like we're going to end up trading above this 20-day simple moving average, barring some like catastrophic, nuclear event. I think it's very likely over the next, couple of weeks that we end up squeezing up to this monthly point of control. Definitely seems like a very highly likely scenario, especially the market just did so well on this dip today. Dip buyers, they just came right in. We got some bad news as well, like the OPEC production cuts. That could have sent the market down the tubes. It did not. NASDAQ also maintaining itself inside of this monthly value area. We have the Russell 2000 also trading right up to that 20-day simple moving average. We have our Dow Jones, which is trading also inside of value. Then the ARK Innovation ETF, this is one of my big trades that I have on right now. This one, as far as I'm concerned, with Tesla being as weak as it has been, Tesla's making lower lows right now. But is the ARK Innovation ETF making lower lows? No, we tested the bottom of value, but we still closed above that 5-period EMA. So I think overall this is looking pretty good. If I zoom into the hourly chart as well, look what happened. We retested the top of this weekly value area, and from there we found some buyers. So I do think this ARK Innovation ETF, I really think it could shock a lot of investors by squeezing much higher. And I'm all about that. I'm here for it. I am positioned for it. Now let's take a look at Tesla. So imagine like the ARK Innovation ETF, it's holding its own while Tesla is really just, plummeting. It's having a really bad sequence. But this bad sequence, it's not going to last forever, right? At some point, people lighten their load. They adjust to the fact that this Twitter deal is likely going to go through. And I would imagine, Tesla has a way of just moving in these really big momentum sequences. And once the selling ends, that momentum kicks in, this one could get going as well. So I think if that occurs, the ARK Innovation ETF is really going to move to the upside. But let's look. We did have some macro headwinds today with the dollar index moving to the upside, up 1.04%. And I think it's good. The market weathered that storm and it, bounced back even though the dollar index remained pretty strong today. In terms of treasuries, we saw a similar headwind for the market. 10-year treasury futures, they closed right at the bottom of the monthly value area, not exactly strong. They sold off. And the 30-year futures closed below value. And the equity still hung in there okay. So definitely seeing some, a little bit of a change in character in the market. But this was MNTK. This was the one that I sold earlier today. This one just complete rug pull, right? The pattern looked great. And then this thing just kept dipping. Honestly, I should have closed this out yesterday as this thing started to cascade. Held on a little bit too long, kind of took my eye off the prize, and today ended up closing this thing out. And hopefully this is the low for anyone that's still in this. But this one, just a bad trade, honestly. And let's take a look. MNTK, what else? TQQQ, this is the one that I added. TQQQ, this one is, just very similar to the NASDAQ. We're establishing ourselves inside a value. So overall, I think it's going to be very important for tomorrow. Obviously, the dollar index, keep watching that and keep watching the bond yields. Today, the market was able to hang in despite the dollar rising. But also, you want to be watching this 20-day simple moving average. because I do believe, again, with that CTA trigger level, could have some fireworks if we get above that level. All right, everyone. Hope you enjoy the rest of your evening. As always, we will see you all tomorrow.